To make it easier to see this presentation, you can maximize your screen by clicking the little box that looks like this in the bottom right-hand corner of the video. So go ahead and click that icon now, and we'll get this webinar started, hosted by Darren Sugiyama and Lionsmark Capital. We hope you enjoy this presentation.
Hey guys, Darren Sugiyama here, CEO and founder of Lionsmark Capital, the most transparent premium financing intermediary in the life insurance industry. So in today's webinar, we're going to cover a topic that we call legacy investing, which essentially uses life insurance as a hedge against risk and provides more certainty for the client in certain areas of their portfolio so that they can really go ahead and swing for the fences and get a little bit more ambitious in other areas of their investment portfolio. I work with investment advisors, CPAs, estate planning attorneys, and family offices all over the country. And so oftentimes they come to me and they say, well, we have this client that is complaining that we're not producing enough yield in their investment portfolio. So we rebalance and reallocate their portfolio to take on more risk in hopes of getting greater returns. Well, the client comes back and says, well, it's nice that maybe we could potentially get higher returns, but we're not completely comfortable taking on more risk. They kind of want to have their cake and eat it too, which under most circumstances is not really possible. However, with this legacy investing platform that we've created, we built an algorithm that calculates just how much more aggressive the client can get in other parts of their portfolio when they insert premium finance life insurance as a hedge against overall risk. So without further ado, let's go ahead and get this webinar started. So our legacy investing platform uses life insurance as a hedge to mitigate risk, while at the same time maximizing the total returns and the net amount that goes to generation 2 at the client's end of life. The traditional way of managing a portfolio, if you want to mitigate risk, is to diversify the portfolio. For example, you could use 50% equities and 50% in bonds. Using this traditional investing method, the client would fund their lifestyle expenses from this traditional managed investment portfolio, and at end of life, the remaining amount would be inherited by generation 2. However, it would be taxed at an estate tax rate of 40% under current tax law, assuming their net worth is above the estate tax threshold. Alternatively, in our legacy investing platform, the client would have two different investment buckets. The first one is what we call the lifestyle bucket. Now, in the lifestyle bucket, we get even more conservative by using a 30% allocation to equities and 70% to bonds. This lifestyle bucket funds the ongoing living expenses for the client. This lifestyle bucket also funds the ongoing cost of a life insurance policy. Now, typically, this life insurance policy is owned by an irrevocable life insurance trust outside the taxable estate. And one of the benefits of the life insurance policy is it provides more certainty for the client in regards to how much generation 2 would inherit net of taxes, because the life insurance policy, again, is owned by that trust outside the client's taxable estate. Due to the increased certainty that the life insurance policy generates in terms of the total net amount that goes to generation 2 at the client's end of life, our platform has an algorithm that calculates just how much capital the client can move from their lifestyle bucket over to their aspirational bucket. So in this aspirational capital account, the client has the ability to take on more risk. In other words, they could invest in certain assets that incur more risk, but also could potentially yield greater returns, things like private equity or investing in tech. Now, at the client's end of life, that aspirational account would be inherited by generation 2 and also taxed at that 40% estate tax rate. However, the life insurance policy would pay out tax-free outside the client's taxable estate. So the question is, how much more yield can we get out of this legacy investing platform? In addition, how does this legacy investing platform perform during boom times as well as during recessions? And that's why we believe backtesting is so important. Our platform analyzes 121 different actual historical 40-year periods of both S&P 500 performance as well as 10-year T-bond performance. To explain our backtesting methodology, we take a look at a starting date of January 1st, 1970. We roll the clock forward 40 years until the end of 2009. In that column, we see historical S&P 500 returns. And during this particular 40-year sequence, the S&P produced a compounded annual growth rate of 6.43%. However, we said, well, what would happen if the client started investing just 1 month later? Let's say the client started investing on February 1st, 1970. Roll the clock forward 40 years to an endpoint of January 31st, 2010, and we see the compound annual growth rate was 6.55%. But then we said what would happen if they started 1 month later on March 1st, April 1st, May 1st, et cetera, et cetera. And so we modeled all the way up until the end of 2019, which created 121 different actual historical 40-year periods that our software analyzes. We take a look at the 40-year period that produced the best compounded annual growth rate, as well as the 40-year period that produced the worst compounded annual growth rate. We typically use the 40-year period that produced the worst compound annual growth rate as our benchmark because we would rather underproject and hopefully over-deliver. So let's take a look at a comparison. We'll compare a traditional capital account, in which case the client has their equity to bond allocation set at 50% equities and 50% bonds. For actual historical equity returns, we see there in the pink section, 1971 through 2010. And in the blue section there, we see historical T-bond returns. We also assume a particular tax drag based on the client's earned income, as well as their state of residence. Then we are factoring in a 50 basis point advisor fee on this hypothetical investment account. We're also going to assume a starting account balance of $100 million. So let's take a look at a comparison between this traditional 50-50 allocation investment account to our legacy investing platform. The goal of this legacy investing platform is to unlock what we call aspirational capital. So component number one of 3 components is our lifestyle capital account. This is the account that's going to fund lifestyle expenses for the client. Here we get much more conservative with this particular account with an allocation of 30% in equities and 70% in bonds. Now, this account is going to fund the client's lifestyle expenses as well as the life insurance policy. Now, we built an algorithm that calculates just how much the client could move from this conservative lifestyle bucket over to their aspirational bucket. In this particular scenario with this particular client, we calculated that they could move 25.31% of their liquid assets from the conservative lifestyle bucket over to their aspirational bucket. And we calculate this by setting the client's life expectancy, in this case we used age 90, and the goal was to draw down from this account to an account balance of 0 at age 90 so that we could fund component number 2 of 3 different components. Component number 2 is the aspirational capital account. In this scenario, because we took so much risk off the table using the life insurance policy as well as the conservative lifestyle bucket, the aspirational bucket has an 80% equities and 20% bonds allocation. In year 2, we see just how much was moved over from that lifestyle bucket, and this more aggressive investment approach is made possible by increasing the certainty using component number 1, the more conservative lifestyle bucket, with a 30-70 equity to bond ratio. And this is where the client can get more adventurous in their investing methodology. They can afford to take on more risk with this particular investment bucket because of the conservative nature of their lifestyle bucket as well as the life insurance policy, which takes us to component number 3 of 3. This is the life insurance policy owned outside the taxable estate in an irrevocable life insurance trust. Now, there are several different loan models that we can choose from. We currently work with 14 different lenders, and we have 5 different loan models. In this particular model, the client borrows the $9.3 million of annual premium from the lender and makes interest-only payments each year on the cumulative loan balance. The client would post a bit of outside collateral, and we would exit the loan in policy year 11. In other words, we would pull from the policy value to pay off the third-party lender, and that amount would be netted against the gross death benefit. As we see over here in column 14, which is the death benefit net of all loans, the net death benefit hits a low point of just over $100 million in policy year 19, which would put the client at age 78. Now, prior to that low point, as well as after that low point, the net death benefit is much greater than that $100 million low point. So let's take a look at the results of unlocking this aspirational capital. On the left-hand side of the screen are the results during the best 40-year period out of 121 periods that we model. And on the right-hand side is the worst 40-year period out of those 121 different 40-year periods that we model. Let's start with the worst 40-year period. That is the ongoing lifestyle bucket account value. Again, that lifestyle bucket is funding the client's lifestyle expenses as well as the cost of the life insurance policy. Again, it's designed to make drawdowns all the way up until life expectancy. In this case, we used age 90. And in year 2, we are moving roughly 25% of that portfolio into a more aggressive or aspirational investment account. This is the investment bucket where the client can become more adventurous and take on more risk in pursuit of higher yields. The third column is the net death benefit of the life insurance policy. If we add those 3 columns together, we see the total net portfolio value that would be inherited by Generation 2 after all taxes, including estate taxes. In the far right-hand column, that is the net value that would be inherited by Generation 2 if they kept all their funds in that traditional 50-50 account. Now take a look down here at life expectancy at age 90. Our legacy investing platform yields over $100 million more going to Generation 2 than the traditional 50-50 portfolio. And this is during the worst 40-year period out of the 121 different 40-year periods that we analyze. If we look at the left-hand side of the screen, at life expectancy, the disparity between the legacy investing platform versus the traditional 50-50 model is tremendous. To look at the same outcomes on a graph, we see the results, and again, this is using a life expectancy of age 90. During the best 40-year period, we have a huge disparity between a traditional investment portfolio versus our legacy investing portfolio. We're talking about 137% greater outcome at age 90. During the worst 40-year period, again, we see a substantial increase in outcome using our legacy investing method. Now, the assumptions we used in this model include a married couple, both age 60, wherein the life insurance policy was designed to hit a low point net death benefit of $100 million. Another way to look at potential instruments to accomplish a very similar outcome would be to compare the premium finance life insurance policy to a non-finance life insurance policy, and then also compare that to a non-insurance-based investment account. In the green section on the left, we see the annual interest contributions to the premium finance life insurance policy. And at the bottom left-hand corner there, we see that the total out-of-pocket expense for the client would be $27.5 million. As we talked about before, this policy hits a low point net death benefit of $100 million at age 78 and then increases thereafter. If we were to look at the exact same life insurance product with a level death benefit of $100 million, non-financed, the premium would be paid out of pocket by the client in the total amount of $2 million per year over the course of 10 years. In this case, the total net outlay would be just over $20 million. However, at life expectancy there at age 90, the premium finance life insurance policy provides $41 million greater value at age 90. So in this scenario, the client would essentially be trading out $7 million for an additional $41 million in the premium finance life insurance policy compared to the non-finance policy. Now, in the blue sections there in column 3, we see a non-insurance-based investment account using the same outlay and the same 6.30% gross return assumption. At age 90, we see a huge difference in the total net amount that would go to Generation 2. $37 million in the non-insurance-based investment account, $100 million in the non-finance policy, and $141 million in the premium finance policy. In the middle blue column, we have the same outlay being invested in a non-insurance-based investment account, and we reverse engineered the calculation to see what the annual gross return would have to be to net the same final outcome at age 90. In this scenario, the equities and bonds account would require a 13.73% gross return to accomplish the same outcome at age 90 compared to only 6.3% in the premium finance life insurance policy. And lastly, we analyzed another non-insurance-based investment account with the same annual gross return assumption as the premium finance life insurance policy at 6.30%, the same net outcome at age 90 and calculated just how much more the client would have to invest on an annual basis to reach the same outcome. In this scenario, the client would have to invest $9.8 million per year over the course of 10 years in order for Generation 2 to net the same $141 million at age 90 as the premium finance life insurance policy. So if we look at dollars in, dollars out, using the same assumptions in all of these different financial instruments, the premium finance life insurance policy outperforms these other assets in a meaningful way. The last thing I'll touch on here is how the index credit assumptions were calculated as it pertains to these numbers we just looked at. We assumed a 6.3% annual index return in the life insurance policies. Now, the 6.30% return is the average return of every 25-year window over the last 65 years with this particular product from this particular carrier at the time we recorded this video. But the actual index credits in a real-world scenario are not based on static returns every year, and certainly not positive static returns every year. The index crediting methodology in this product utilizes a cap and a floor. The floor is the minimum annual gross return allowable regardless of what the S&P 500 does, and the cap is the maximum annual allowable return. Now, we built a proxy that analyzes those same 121 different historical 40-year periods, and we're going to take a look at the 40-year period that produced the worst compounded annual growth rate out of those 121 different 40-year historical periods that we analyzed. We're also going to take a look at internal charges within a life insurance policy. In column 3 there, those are taken directly out of the life insurance carrier's illustration, and these represent the ongoing policy charges. In columns 4, 5, and 6, we see the historical calendar years in column 4. In column 5, we see the historical S&P 500 returns. And in column 6, we see the 0% floor and the 12% cap applied. So as an example, in 1973, when the S&P 500 produced a negative 41.40% return, the index credit would have been 0, thanks to the 0% protective floor. 2 years later, in 1975, when the S&P returned over 25%, the index credit would be capped at the maximum return allowable in that year, which would have been 12%. Now, each year, the client can make a decision to opt in or opt out of receiving this multiplier bonus. The multiplier bonus is multiplied by the after floor, after cap return, and there is a cost to opting into this proposition. The cost is in the form of an asset-based charge. So in column 1, we see that is the asset-based charge in the form of a percentage. And in column 2, we see the dollar charges, which would be in addition to the standard policy charges. Including the multiplier bonus in column 10, we see what the index credit would have been in these back-tested years under these floor, cap, and multiplier assumptions. Now in the orange columns here, in column 11, we see the dollar index credits that would be applied to the cash value in each year under these assumptions. And we see in some years the dollar credit would be 0, again, due to the negative S&P return and the 0% floor. In other years, the index credit from a dollar standpoint would be quite substantial. In column 12, we see those are the ongoing charges, which include the standard charges as well as the additional asset-based charges. And in column 13 on the right in the orange section, we see the years wherein there are red fonts. In those years, the charges would have been greater than the index credits. So those are the amounts that the cash value would decrease by. In the black fonts, we see those are years where the index credit was greater than the charge in that given year. So those black font values are the net amounts that would be credited to the cash value, net of charges. So the question becomes, as we look at these back-tested models, especially this one during the 40-year period that produced the worst compounded annual growth rate, how does this adverse scenario compare to the static return scenario using an assumption of 6.30% return every year? In this graph, the black line represents the static as illustrated death benefit in the carrier illustration, and the blue line represents the cash surrender values net of all loans on an ongoing basis that was taken right out of the carrier illustration. The heavily dashed green line represents the simulated cash value in our proxy during the 40-year period that produced the best compound annual growth rate, Again, this is with all the volatility as well as the charges from a historical standpoint. And the dotted green line represents the simulated cash value in our proxy during the 40-year period that produced the worst compound annual growth rate. Lastly, the solid green line represents the ongoing simulated cash values in our proxy, assuming the historical returns starting in the year 2000 and then going all the way up until the end of last year, 2023. And then thereafter, we use the static return of 6.30%, the same that we showed in the official carrier illustration. Now, during this particular time, starting in the year 2000, the first 10 years of the sequence was the worst 10-year sequence in modern history. During that period of time, the S&P produced 4 negative return years, which would have resulted in 4 0% index credits during the first 10 years of the sequence. However, we also used historical borrowing rates during this first 10-year sequence as well. We see over time, this adverse sequence of returns actually produced a better outcome 40 years out than the worst 40-year period, and almost double the economic benefit than what the carrier illustration showed, assuming that static return of 6.30%. So as we come to an end here, we did look at this slide a little bit earlier. Again, during the best 40-year period, we see 137% greater final outcome at age 90 using our legacy investing platform versus a traditional 50-50 investing methodology. And during the worst 40-year period, 113% greater outcome at life expectancy. So if you have a client that wants to be more adventurous and more aggressive in their investing methodology, but is concerned about incurring too much risk, this legacy investing platform, which incorporates a premium finance life insurance policy as a hedge against risk, can be a mathematically prudent way for your client to accomplish their goals.